This is Brad Berry, Chief Investment Officer and Portfolio Manager with Dynamic Wealth Group. Welcome to this market and economic update. In this video, we'll discuss the escalating trade tensions between the United States and China, what it means for markets, and the significant economic interconnections between the two countries. The White House has announced a 90-day pause on tariffs on most of our trading partners. This now puts trade tensions between the U.S. and China in focus. Tariffs have escalated to unprecedented levels, including 145% on Chinese goods by the U.S. and 125% on American products by China. The current tensions reflect a deeper shift to a multipolar world where both countries exert significant global influence, replacing the post-Cold War unipolar American dominance. While the situation is still evolving and deep economic connections between the United States and China are unlikely to go away, history suggests that markets and the global economy can be resilient even if there is some short-term volatility. In environments like these, and really at all times, it's important to maintain a long-term perspective and follow a truly diversified approach as investors. First, this chart shows U.S. trade with China over the past 2 years. It highlights trade activity from the perspective of the United States. Specifically, the U.S. imports many more goods from China than we export. This is true even when we include services that we export to China. Current tariff levels above 100% would potentially more than double the price of goods traded between the U.S. and China, all things being equal. Investors are now concerned not only due to higher prices, but because it's been unclear how far the administration would go in these negotiations. The administration's 90-day pause on tariffs on other countries suggests the White House still would like to achieve new deals. The fact that goods like technology products are currently exempt from tariffs also suggests that the administration is sensitive to higher costs and the impact on companies. In 2018 and 2019, companies demonstrated resilience in the face of tariffs by adjusting supply chains and absorbing costs. Today's tariffs present greater challenges, but there are still signs that deals can eventually be reached. For long-term investors, the challenging market environment has created more attractive valuations across different sectors, while rising interest rates offer enhanced portfolio income opportunities despite the bond market volatility. Next, this chart tracks the performance of several currencies over the past 2 years, with the value of each currency re-indexed to 100 at the start of the period. It highlights that currency volatility has increased globally, with the US dollar index recently falling to the low end of its three-year range. Contrary to expectations that tariffs would boost the value of the US dollar. China's economy faces its own problems as well. China's GDP growth slowed to 5.4% year over year in late 2024, and economists have dropped their 2025 forecast to below the government's 5% target. The Chinese government is considering additional stimulus measures beyond last year's significant measures, including a 10 trillion yuan package. The People's Bank of China has also allowed the yuan to weaken to its lowest level since September of 2023. A weaker currency potentially offsets tariffs through cheaper exports, but this strategy risks capital outflows and further financial instability. Finally, there have been investor concerns that moves in the bond market may have been caused by China selling off U.S. treasuries. While it's difficult to verify, it's important to keep in mind that China only holds about 2.1% of total U.S. government debt, as shown in this chart. Most treasury securities are owned domestically by U.S. individuals, corporations, and government entities. While China reducing its treasury holdings could cause short-term market volatility, countries hold U.S. treasuries for an important reason. The U.S. dollar and treasuries are still the most stable in the world, and these assets have maintained their safe haven status. Despite U.S.-China trade tensions creating uncertainty, Financial markets have proven resilient long term, suggesting truly diversified portfolios aligned with long term goals remain the best approach. Investors should expect, though, that tensions will continue, regardless of how tariffs evolve in the coming months. I hope you found these high level insights helpful. If you are a financial advisor and would like more information on our multidimensional approach toward asset management, feel free to download our white paper titled Busting 7 Risk and Return Myths. You can click the link below or visit our website at dynamicwg.com or email us at info@dynamicwg.com. If you're an individual investor, we are happy to address any questions you may have and put you in touch with a qualified advisor if so desired. Until next time, take care, everyone, and make smart, logical, and fact-based financial decisions.